Most Americans under 35 have less than $1,000 invested, not because they can't afford it, because nobody told them it was even possible to start. But here's what changes everything. What if you just picked a number, any number, and moved it into the market the same day every single week? Without looking at the news, without trying to time anything, without knowing what the economy was doing, that's exactly what happened. $100 every week for 52 weeks. And what came out the other side will either surprise you or frustrate you, because the math is simpler than you think, and most people are still getting it wrong. The reason this matters right now, specifically for you in your 20s or 30s, is that you are sitting in the most powerful window of your financial life. Time is doing all the heavy lifting if you actually show up. By the end of this, you won't just know how a $100 a week investment strategy played out. You'll understand exactly why it worked, the one mistake that kills the results, and the first move you can make today. This is Money Axis. Let's get into it. Nobody tells you how paralyzing it feels to open a brokerage account for the first time. You're staring at a list of tickers, reading phrases like expense ratio and market cap and sector allocation, and somewhere around the fourth tab you have open, you just close the laptop because it feels like you need to be an expert before you earn the right to invest. I didn't understand this until I stopped trying to be smart about it. The decision wasn't what should I buy? The decision was when. And the answer, which changes everything, is the same day every week, no matter what's happening. So the experiment was simple. $100 every Monday into a broad index fund. No market watching, no rebalancing, no waiting for a dip. Just $5,200 over the course of a year. And what it turned into, and more importantly, what it taught about how investing actually works, is what we're breaking down right now. 0.01 dollar cost averaging is a cheat code. Most people sleep on. Most people think you need to buy at the right time. But here's the truth. Nobody knows the right time. Not the hedge funds, not the analysts on TV, not the guy who posts about crypto at 2 a.m. Dollar cost averaging, or DCA, means you invest a fixed amount on a fixed schedule. Period. When the market is up, your $100 buys fewer shares. When the market drops, your $100 buys more. Over time, your average cost per share automatically lowers. You're not timing the market. You're outsmarting it by making timing irrelevant. Across 52 weeks, some of those $100 investments landed on all-time highs. Some landed during corrections. The average came out ahead of what a single lump sum investment would have produced if you'd made the wrong call on timing. Set up a recurring weekly investment today. Even $25 counts. Automate it and remove the decision entirely. 0.02, the real returns are in the numbers. You never see coming $5,200 in, so what came out? In a year, tracking a broad S&P 500 index fund with a historical average annual return near 10%, the final portfolio value sits somewhere between $5,400 and $5,700 after 12 months, depending on when those weeks fell in the market cycle. That's a return of roughly 4 to 9% on the money actually at work, not groundbreaking. But here's what matters. That's year one. Because the gains don't come in year one, they compound. That same $5,200 starting point, left untouched for 20 years at 9% annual return, becomes over $30,000 without adding another dollar. But if you keep the weekly habit for those 20 years, you're looking at over $300,000 from $100 a week. That number is not a typo. Use a free online compound interest calculator. Plug in $100 per week, 9% return, and 20 years. Watch the number that appears, 0.03. The fund you pick matters more than you think, but less than you fear. There are thousands of investment options, but for this strategy to work for DCA to do its job, you need something that doesn't randomly go to zero. The $100 per week experiment used a total market index fund, specifically one that tracks the S&P 500. Those are the 500 largest companies in the US. When you buy it, you own a tiny slice of Apple, Microsoft, Amazon, Google, and 496 others in one transaction. If one company collapses, the others absorb it. The fund charges about 0.03% per year in fees. On $5,200, that's $1.56 a year. It's basically free. Individual stocks are not the same thing. One bad earnings call, one bad CEO decision, one industry disruption, and your $5,200 could be $900. The index doesn't have that problem. Search VOO or VTI in your brokerage app. Those are two of the most used S&P 500 index funds in the country. 0.04. What the dip weeks actually did to the portfolio. At some point during the year, the market dropped. It always does. And this is the moment that separates people who build wealth from people who talk about it. During the two biggest dip weeks, when the index fell roughly 4%, the automatic $100 investment still went in, which meant those weeks bought more shares at a lower price. When the market recovered 6 weeks later, those discount shares were worth more than everything bought at the highs. The dip didn't hurt the portfolio. The dip fed it. People who paused contributions during the drop missed those purchases. Over the full year, they ended with fewer shares and less money despite putting in the same total amount at other times. If the market drops next week, don't skip your investment. That is the week you want to buy. 0.05, where you put the money changes. Everything. Not all accounts are created equal. And this is the one that trips up almost everyone doing this for the first time. If you put $100 per week into a regular brokerage account, you'll owe taxes on every dollar of gains when you sell. But if you put that same $100 per week into a Roth IRA, which is a retirement account the US government gives you as a tax incentive, those gains grow tax-free. Completely. You pay taxes on the money going in, and everything that it becomes over 20 or 30 years comes out with zero tax bill attached. The contribution limit for a Roth IRA in 2025 is $7,000 per year, which is exactly $134.61 a week. A $100 per week strategy fits perfectly inside that limit. The same $100. The same index fund. Completely different tax outcome. If you don't have a Roth IRA, open one today at Fidelity or Schwab. It takes about 10 minutes in a year, and there's no minimum to start. Common mistakes. Most people get this wrong. Number one, waiting for the right time to start. Every month you wait costs you not in fees, not in market risk, but in the one thing you can never buy back: time. A 25-year-old investing $100 per week has 40 years of compounding ahead. A 35-year-old has 30. That 10-year gap translates to hundreds of thousands of dollars in the final number. The best time to start was last year. The second best time is today, not next quarter, when things feel more stable. Here's what I almost did wrong. Number 2, investing in a taxable account before a Roth IRA. The first instinct is to open a regular brokerage account because it feels simpler. But if you qualify for a Roth IRA, which most young adults do, that's the account to fill first. The tax-free growth is worth more than any fund you could pick. Most people get this wrong. Number 3, checking the balance every day. This one is silent but devastating. Every time you check your balance during a down week, your brain is calculating a loss you haven't actually experienced. People who check daily are 3 times more likely to panic sell during dips, according to behavioral finance research. Set it up, automate it, and look quarterly at most. The returns show up when you stop watching. Money Axis Action. Step for today. Open a Roth IRA at Fidelity.com or Schwab.com right now. It takes under 10 minutes and no minimum deposit is required. Once it's open, search for the ticker VTI or VOO. Set up an automatic weekly investment of whatever amount you can commit to, even $25. Turn on automatic investing so it triggers every Monday. Then don't touch it. That's it. That is the entire strategy. The sophistication comes from the consistency, not the complexity. Here's the thing about $100 a week. It's not a life-changing amount of money today, but the 52nd time you do it, the 104th time, the 520th time, the number on the other side of that habit is something most people will never see because they never started. The investing part is easy. The waiting is the hard part, and most people quit waiting before the math gets interesting. If this broke something open for you, if you've been sitting on the edge of starting and this was the push, then the next video is going to hit even harder because we're going beyond the basics. What happens when you start optimizing the account, the fund selection, and the tax strategy? The next level of this system. If you want to stay in this, if you want the direction, not just the information, subscribe to Money Axis, not because of an algorithm, because you came here for a reason, and this channel exists to be that reason every week. I'll see you at the next Axis point.